Well, welcome everybody to our Rethink Wealth webinar on unlocking potential in your business using a management service organization or an MSO. We're really excited to get into this topic today. It's one of a handful of things that our team will use from time to time as we go through and we're working on tax strategies specific to business owners. There's a number of techniques that may apply for different businesses, different situations. What we're going to explore together today is a little bit of the overview of how this works, what the kind of impact is, and really raise the question of whether this would be something that's worth exploring for your specific situation. I'm your host and guide for today. My name is Austin Bransgrove. I'm a managing director and financial advisor here at Rethink Wealth, head of financial planning here for the firm, and leader for our offices up in Dallas, Fort Worth. Our team has worked with clients in all over the country. I think most of the 50 states. We've been around for just over 16 years and manage over $1.6 billion. We worked with thousands of families and businesses all over the country. And as we consider the management service organization, the question really comes up because all too often what we find is that business owners come to us and they're fresh out of ideas with how to go through and manage taxes. They see their success in their company, they see their success financially, and what happens is as they grow, a lot of the baseline strategies and techniques that worked for them early on become less and less effective as they go, right? We're going to talk more about that, why that is, how that functions here. But the crux of it really is that a business owner, and you know this better than anybody, does a lot of things in order to get from point A to point B with the sales of products and services. And it's very simple to say, oh, well, this business owner runs this company. But in real life, there's a myriad of different things that you have to do on a day-to-day basis that aren't really necessarily in your job description, right? A lot of our best clients, best entrepreneurs that we work with, they understand that at the end of the day, the buck stops with them. And there's a lot of things that they have responsibility for, even as they grow and the tasks start to fall on other employees' desks or other partners' desks if they have some co-owners. And the question really is, what if there was a way to account for all of those things that you actually do in your business, not just the stuff that's the title, not just the stuff that is from point A to point B and getting to those products and services that you sell? Well, in our experience, what we'd see is that you'd probably recapture tens of thousands of dollars in tax that you're previously overpaying to the government. It's like optional patriotism, the way that we see so many business owners show up. And maybe you're cool with that. If that's the case, no problem, right? Like we're here to just say, hey, what's possible? What could we go through and explore? But most of the clients that we work with, as we're exploring these tax strategies for businesses, they think that they can do a lot more with a dollar that they've got than what the IRS is going to do when it's taken in Washington, right? And you see some of the stuff here on the screen, but I find over and over that some of the best creation and inventions and benefits to the economy and communities and employees and families comes from the thriving profitability of a business. And extra money, like optional money that our clients will have to go through and pay in taxes, a lot of the people we work with really believe that what happens in Washington when those dollars go through the system, it's not as much bang for the buck as what they could go and create on their own, right? Whether for the business, for their communities, for their own families, okay? So this is a lot of the problem, and so much of it stems from the way that just as a default, most of our clients are taught and instructed on how to form the foundational structure of their operation, right? Almost all the time, What we see is that clients come to us with a pass-through business. So they've got an S corporation, they've got a partnership. I've seen disregarded entities as a single member LLC before. And what happens is all this revenue comes through, right? Say there's $1.25 million in revenue, you got a 50% profit margin. So at the end of the day, there's $625,000 of profit coming out of that business. Some of it's going to go through W-2 wages that your CPA helps you to figure out and go through and set up. And a lot of the rest of it was going to come through those K1 distributions. And maybe, and we find this is like really, really common, that if a family's making $600,000, $700,000, $1 million out of their business, it's not super common that every single penny is spoken for, right? Like most of the time, all of that money is not going to lifestyle. We've seen it go to all kinds of things. Maybe it's going to debt pay down. Maybe it's going to reinvest back into the business. Maybe it's going towards after-tax expenses and building up some capital for future projects in the business. But the thing of it is that in the screen here, this example we've got, this $300,000 of excess income, that's showing up on your tax return, whether you like it or not, whether you need it or not, whether you're spending it for lifestyle or not. That money's showing up and getting taxed at some of the highest possible rates. Today's tax rates, you're going to be in the 35 to 37% bracket with this kind of picture on your tax return. And you look at this and you say, oh, well, my business is $2 million. My business is $1.5 million. My business is $5 million. The more that's there, the bigger that tax problem becomes, because now you're paying tax not just on what you're using and consuming as a family, but the IRS is going to get their pound of flesh first, right? That's just how it works. And for many, many years, the S corp was the way to go because corporate tax rates could be as high as 35%. And so it just made sense that, well, if we're going to have to pay tax anyways, we might as well go through and just do it this way because we'll pick up some tax savings on the margin there. And the thing is, as we consider, well, what if it's possible to separate out all of the stuff that you do in your business with the actual product and service that your business provides to the public? What if, from a tax standpoint, that was two different things too? What if the product and service that your business is providing to the public flowed through the same structure that you already have, but you created for yourself this management business that served the needs, the business management needs of your operating company, right? And so imagine for a second that you set that up. You set it up as a C corporation, okay? A lot of industries have been doing this for years and years and years. Maybe you're a dentist on the call today, or you've got some familiarity with the medical space. DSOs, MSOs, they all follow the same kind of playbook here, where you've got this one management company supporting the public-facing company that's doing all the work for the public, okay? So imagine, what if it was possible that $300,000 that was surplus in the previous slide now landed and was surplus, was revenue that was all net income, all taxable in a C corporation? Well, a C corporation, you're not paying 35 or 37% tax brackets. You're paying a 21% tax. And even with the Tax Cuts and Jobs Act, and you may be hearing a lot of noise right now about what's going to happen and this and that, the 21% tax rate is one of the handful of things that was established as something that was not going to expire from 2025 to 2026, okay? And so what happens is that after taxes, now you've got $237,000. Maybe there's some after-tax expenses that are in there. We've just noted some kind of rough figures there with 137 grand. And now there's $100,000 of retained earnings, okay? Now, maybe these are similar to your numbers. Maybe your numbers, you add another zero at the back, right? And you're talking about $1 million and $3 million and $2.3 million as you're going through the examples. But what happens as you think about the C corporation is you start to pick up some of this efficiency because retained earnings are not taxed again, right? It's not like if you have a pass-through business where you're going to go through, you're going to pay all this tax, this 35, 37% tax rate as you hit the higher income levels. Here, now you've got retained earnings, and all you did was pay that 21% tax up front to get to that point. Okay. Um, there's no real need to go through and justify a lot of the retained earnings. I think as long as there's a need for cash in the operation of your business, there's a lot of check boxes that get you to that point. You can justify millions and millions. Some of the biggest companies in the United States justify billions of dollars of retained earnings that's sitting on their balance sheet because they know there's these operational needs that could come up in the future and they may want the capital to go through and use. Okay. And so as you think about the impact of this, what happens is now you've got these two companies operating side by side to support your efforts, and you're starting to silo out functions that create some levels of efficiency, that create some levels of asset protection. Let's look a little bit more at how that works. So you've got operating expenses. Okay, some of those are going to go through in your operating company, and you're going to have ordinary expenses that make sense to keep there, just because they're tied to the actual service being provided to your customer, the product that you're selling. You've got cost of goods, something like that, right? On the other side, maybe it makes sense that some of the management functionality, sort of like a PEO, is pulled over into this other silo on the right hand side, right? So now you've got these two vertical flows of money as you go. And what happens is you end up with little to potentially no excess income in your pass through business on the left. And as you have management expenses related to salaries or property management in a couple of different locations you have, or need to go through and order things, think about all of this stuff. Maybe you're a dentist on the call. Think about all of those things that a DSO who would come in as a partner with you would start to provide as services for the practice. Those are the types of things that start to fall under your own management company. Why do you need private equity money to go set it up? You can create it on your own. Okay. And your management company should be providing real economic value to your business. So you're isolating out those two situations where you've got capital being retained on one side in the management company, and you've got just the interface with the public on the left. One thing that we see come up a lot as we go through and explore these types of situations is it's pretty common that a lot of our clients will have a few different locations for their business, right? Maybe they'll have a couple of different offices where they're going to see clients or patients. Maybe they'll have a couple of different storefronts that they'll go through and use. And generally, as we bump into those clients, what we're going to find is that for a lot of good reasons, their accounting team, their legal team has said, hey, you need to set up two different companies for each of these locations, right? So they'll set up one company over here for location A. We'll just call that company A. They'll set up another one for company B for the second location. Maybe they've got a third, company C, okay? And what inevitably happens more often than not is that as you go through 1 year and the next year and the next year operating in this way, you start to end up with, well, this employee kind of goes back and forth and floats between the different locations. And you've got one company that's doing administrative work and kind of management of things. And that person is ordering supplies and dealing with systems for all three locations, company A, B, and C. And you yourself, as one of the foundational members of the business, not with your owner hat, but with your employee hat on, are also doing real, honest to God work at company A, company B, company C on a regular basis. And I just want you to think for a minute, what if some massive Fortune 500 company operated the same way? What if Target had this location and they said, "Man, we really need some things. We're gonna have Walmart send some employees over to help cover for us." Is there any scenario where Target wouldn't be owing Walmart money for the services that those employees would provide? No, right? A, you think about it, like that's never going to happen because they're competitors in the space. But there's no scenario where company A in the world is going to just borrow for free any kind of employees or services or supplies from this other business, right? So why are you? Why do you have it set up so that you've got company A, company B, company C maybe, and you have one employee that kind of just goes back and forth everybody, right? Do they get three different paychecks? Is it all segmented out so their time over here is clocked, their time over there is clocked, their time over here is clocked? Or is it one paycheck and it's you just kind of move money where it needs to be moved, right? Well, the thing is, the danger that occurs when you don't treat each of these three businesses as separate and distinct entities is that if there's ever some kind of a liability issue, it's probable that any kind of plaintiff who's suing you, if they win, they're probably going to go to court and say, Judge, they don't treat it as three businesses. I shouldn't have to either. And now you got this claim walking across all three businesses, right? Part of the asset protection of thinking about how do I silo the stuff that's got to occur to run the business with a management company and the things that occur day to day for the products and services that you're providing and selling to the public is that you can isolate out and you can say, hey, if there's shared employees that do work across a lot of different locations, or if there's shared supplies, or if there's shared resources, all of those things live underneath the management company. And now your operating business facing the public is paying a full market value rate to the management company. And you've de-risked from an asset protection, a liability side there, a lot of the potential exposure because you start to actually treat each of your distinct businesses as separate and distinct businesses, right? So if there is a problem, if there's a lawsuit, if there's a slip and fall, it could be something super simple, totally unintentional, right? Just one of those accidents that happens. Well, wouldn't that be a lot better if it was isolated and siloed so it only hit one piece of your operation? It didn't have the potential to bring down the whole ship, right? The other thing that we see as we go through this is now we start to get to pick. You as the business owner, you start to get to choose. Well, what makes sense to be shared? What makes sense to keep under my operating business? How do I go through and build this in a way that is efficient and scalable and allows me to operate well, not just go through and pick up some tax benefits, right? Not saying you don't get some tax benefits as you can go through with this planning. You absolutely can. But it's got to be about more than just a tax play where you say, oh, well, I don't want to pay tax, so I'm going to move this over. The IRS has said, and the courts have long upheld that that's not a valid reason to have two different companies, right? You got to actually treat them as two different things, run it as a management company. Same kind of train of thought that a lot of private equity backed ventures have done for years and years and years. Okay. If you got a question, I should say, if you got questions about any of this stuff, well, how does this work? What about this? What about retained earnings? Shoot them in. We're watching questions as we go through all of this here and can totally expand on any of these points as they're coming up. I'll pause here in a bit and we'll see if any questions are popping up just around this difference of operating business, pass-through business, management company, C corporation. Okay. All right. So you may be thinking here, Austin, that's like all well and good, but is the juice worth the squeeze, as I would say, right? Is it really worth it? What's it do? Well, let's unpack that a little bit more, okay? So here we go. We've got this rough analogy here. What's happening today? Plug some numbers in, and we've got 1.2 million bucks, right? As this goes through, just the rough numbers, we're looking at a couple $100,000 of excess as things stand today, right? $198,000 of taxes coming through, a whole bunch of distributions, $400,000 of excess income, and money that is landing in your personal world, at least on your personal tax return every single April, but you don't really need for personal expenses $220,000, okay? Well, if it was possible to go through and use this C corporation, and sometimes it makes sense, sometimes it doesn't. But if it was possible, how we would go through and do that is we'd complete what's called a management fee analysis study, MFA study. You see that right at the top between the two circles. What's that built on? Well, it's built on the very things that uh, any auditor from the IRS is going to go look at. We're going to look at, are we using fair market value rates? You can't just make up the numbers. So we're going to look at Department of Labor databases. What's the fair market value rates for different kind of services or wages that certain job functions will earn and go through and employ? What are the valid types of profit margins that we're allowed to build in that we see in the fair market between two unrelated owners? What do they go through and do? What's happened with audits before? What has occurred in cases? There's active there's settled case law on this that have told us this is how you go through and do it if you want to do it in a way that is totally above board. And so what happens is maybe it's possible that all $220,000 is available to go through and move over to your MSO, right? And so essentially, you're looking at, let's have your management company perform services for your S corp or your partnership, your LLC, that are worth $220,000 at the end of the day, right? So we're moving $220,000 of what otherwise would be profit from the S corporation, some expenses baked in, over into the C corporation. Okay. And what happens is now we've got $112,000 of excess left in the S corporation. You see that on the bottom left. The C corporation ends up with $220,000 of revenue. We've got some tax there and $174,243 of retained earnings. And this very simple picture, right? Without any robust analysis here in terms of, well, what if we do this? What if we do that? We're just giving you an example of kind of what are the mechanics? How does this work? You go from $198,000 of tax today to less than $134,000 with this simple modification. It's $64,438 of honest to God tax savings this year. Over 5 years, it's $322,000. 10 years, you're talking about over $640,000 of tax that you wouldn't be paying to the IRS, right? These are all only federal numbers because we work with people all over the country. And so you end up with this tax only paid on the dollars that you want and need for your lifestyle. Excess funds are stewarded inside this management company with this agreement between the two corporations. And now maybe there's the opportunity to start getting eligibility for other kinds of credits or benefits. Maybe it's possible that your S corporation, which has previously earned far too much to get eligibility for QBI, it allows for 20% deduction of your taxable income under Section 199A. Maybe you're eligible for that again with this simple kind of a move. Maybe this move here pulls enough money off of your personal tax returns and into this corporation then now you have eligibility for some simple things like child tax credits, or you're no longer in a surplus tax net investment income tax rate for what happens out of your investment portfolios, things like that. And you can set these up with timing that occurs different times over the years. So your S corporation may have a fiscal year that goes January through December. Maybe it makes sense for your C corporation to have a year end of September 30th. Well, now every single year you've got timing differences where you can pick and you can look at, well, do we need to modify anything? Has the business needs changed? Should we go through and make any adjustments? And you can adjust the payments for the management fees and the actual services provided between the companies to accomplish real tax planning. So you can pick kind of more when and how do you go through and pay the tax bill. And as we look at the opportunity that comes from that, right? $644,000 of potential tax savings over a decade. I'm going to ask, what do you think you could do? What do you think is possible for you to do with over $64,000 of tax savings this year? Maybe your number's bigger. Maybe it emerges a little bit less. But is the money better in your hands than in the hands of the IRS? Let's look at just one example, okay? One of a lot of things that were possible. So imagine these 10 years, you're going to save 64,438 bucks, okay? If we could just go get a 6% net return after taxes, after fees, 6% net return over those 10 years, every single year you're putting it away. At the end of 10 years, there's nearly $1 million, $900,305. Okay? Money sitting there, retained earnings inside your C corporation. What if after 10 years you said, you know what, this was great while it lasted. I'm not going to do anything else. Okay? And there's no more management fees, there's no more tax savings happening for the next 20 years. Well, at the end of 20 years, that $900,000 would grow to nearly $2.9 million. And if you think about the impact that that could make for your family, for your life, what happens is that imagine we took distributions out of that for 22 years. We had $2.9 million. We take out 5% every single year, which every single financial planner is going to tell you is a lot in terms of a distribution rate, right? So take all of this with a little bit of just understanding this is an example, this is an illustration. Are you going to do this? I don't know. Are you going to do something that could have this kind of impact? Maybe, right? But if we took out $144,000, gave yourself a 3% raise every single year for 22 years, got a 6% rate of return. At the end of 22 years, you'd still have almost $1.8 million, and you would have taken out $4.4 million. That's the impact, right? These are all gross distributions. That's the impact just of the lost opportunity cost that without a strategy like this, all of this economic value is going straight to the IRS. $900,000 over the next 10 years, straight to the IRS. Over 30 years, 10 years of savings, 20 years of deferral, $2.9 million that could be somewhere in a company on your balance sheet that otherwise would be in the coffers of the IRS. And over the course of distributions, gross distributions of nearly $4.4 million, still over seven figures left to go ahead for legacy that otherwise is going to be straight in the coffers of the IRS. So let's unpack this a little bit more. What's happening here? Well, from age 42 to 52, you are executing and implementing the strategy, right? You're running, you're growing, you're building. $644,000 of tax years overpayment under this kind of structure that you will have avoided and recaptured back for you to do something on your balance sheet. And as you do something there, from age 53 to 73, you wouldn't have just left it in cash. It would have grown along the way, potentially $900,000, right? And it continues to grow, continues to build for your future to be nearly $2.9 million by the time you're 73 years old. And so as you go through this, $644,000 of optional payment to the IRS that you decide, you know what, I'm going to restructure. I'm going to change how I go through and have this set up so I keep those dollars. I get the vote on what to go through and do with them. Adds up to $4.4 million of distributions and almost $1.8 million left by the time you're 95 years old, right? So as you think about just an illustration, some simple numbers that you go through and plug in, is it worth it? Is it worth looking at this? Is it worth recapturing that $644,000 of potential tax overpayment to instead reinvest in yourself, reinvest in your business, reinvest in growth for you and your family? Or is it worth it to go ahead and pay that to the IRS, right? That $2.9 million by the time you're at age 73 with $4.4 million in distributions, $1.8 million in balance, right? And I go over this a handful of times because a lot of us, the numbers were like, how on earth is this even possible? How is this possible? And I didn't even know about it. But this is the discussion here at the end of the day. Is it worth overpaying the IRS to the potential cost of $6.2 million that could positively impact you and your family's life? There's a tremendous cost here. There's this thing that we talk about a lot as financial planners, and I imagine almost nobody else really talks about it. My wife's not a financial planner. Every time I use phrases like this, she rolls her eyes at me. Okay, and there's this phrase called time value of money. And essentially what it means is fancy words for opportunity cost, right? And you can think of it, it's why everybody on TikTok goes and says, hey, don't buy that Starbucks. That $4 coffee is going to cost you a whole lot. This is the same idea, okay? A dollar that is overpaid optionally in taxes that could be avoided with a different structure and different planning has the potential to go through and create many times its own worth as you think about the impact over decades for yourself, right? And so here in this example, $644,000 of potential overpayment, doing nothing, continue operating as you are today with business A, business B, business C, exposure to the IRS, exposure to potential asset protection issues, exposure to potential operational inefficiencies, versus dynamic planning with a team around taxes and structure and asset protection. Tremendous economic value that could be yours. And so if these things are coming up, and I'm going to pause here for questions as we sit on this slide, my invitation to you today is scan the QR code on the screen. It'll take you right to a link to book on my calendar and schedule a complimentary opportunity review, right? It's going to be a business consultation review on the calendar as you click that link, and we'll just explore it together. I don't know, having never met you and never talked about your business, does this make sense? Maybe, maybe not, right? But if you're walking through this today and we're looking at the potential positive impact, I got to ask, is it worth some time to go through and explore? Would this apply to you? Okay. I'm going to keep this up. We got a handful of questions come in. First one that came in here is, I'm in Massachusetts. Does this work in Massachusetts? And the short answer is yes. We have worked with clients all over the country. Certainly state income taxes that are different in different states, right? Massachusetts, Connecticut, New Jersey, New York, California, et cetera, et cetera. All of those state tax rates will tweak the actual output of numbers from kind of what we went through and looked on the screen together. But absolutely, these strategies can make sense in any state, and we've used them all over the country. So if you're in Massachusetts, yes, absolutely. We've got licenses in Massachusetts. We go through and operate there, scan the QR code, and let's dive in. Let's start to take a look. Second question that I got is, well, what if I'm already an S corporation? Is it easy to make this change, right? Great question. Yes, absolutely. It's easy to go through and make this change because we're not talking about converting an S corporation to a C corporation, which is its own change. That's not all that hard either. But what we're talking about is adding some levels of choice to your corporate structure so that you get to start to pick. Should this fall under your C corporation? Should this fall under your S corporation? What services should your C corporation provide to your S corporation? Right? What are the fee rates there? We're looking at those DOL databases, figuring out what's the fair market value for the goods and services your C Corp provides to your S Corp. So yeah, absolutely easy to go through and implement. These techniques are very straightforward to go through and add, so long as the team that's supporting you understands how to go through and add them. Okay. What documents do I need to get started? Great question, right? Glad you asked. So as you look at this, you're like, hey, I got to check this out. I need to figure out if this is for me. Maybe it is, maybe it's not. Scan the QR code. Go ahead and put a time on the calendar. And what's going to happen is one of our team members here at Rethink Wealth is going to send you an email. and help you coordinate getting together just a handful of initial documents. So, what are those things? Number one, personal financial statement. We need to understand, what do you currently have, right? This technique can look very different depending on the circumstances that you have. Maybe this one just doesn't fit at all, and we need to go and look at some other strategies that could be a better fit for your own business and for your balance sheet. So first, personal financial statement, understand what you've got. Number two, we need to understand your tax returns, not just for the one business that you're thinking about, but if you've got a couple of different companies, we need to understand 2 years of business tax returns. If you're partway through, like if you just finished last year and we don't have tax returns done yet, or you're on extension, they're not done yet, no problem. We need that profit and loss statement and end of year balance sheet for your business as well, just to catch up. So we've got pretty close to up to date numbers with what's going on there. And then your personal tax returns as well, right? All these things need to fall into place. So business tax returns for 2 years, personal financial statement for today, and the most recent profit and loss and balance sheet for your business. Just last quarter's numbers are perfect on that. Obviously, you have a question, our team's going to help answer as you go through and after you get that appointment set. Okay. Here's a good one, and I didn't get into this a lot. I got this question. Well, what about the impact of double tax? Okay. Great question. So the thing with double tax is that in 2017, the tax code changed. It was called the Tax Cuts and Jobs Act. Okay. And you may have heard a lot about the news. There's a whole lot going on right now with taxes, just with changes as President Trump's back in office. And the Tax Cuts and Jobs Act, one of the things it did is it changed corporate tax rates to go to 21%. And so it totally can go through a slide on this with you, but the long and short is that as we're looking at this, a lot of times people will go through and they'll say, hey, well, double taxes, if I take money out of the C corporation, I have to pay tax. And the short answer is maybe, right? Sometimes there's ways to go through and put plans in place, like executive benefit plans, where you can potentially avoid tax, at least at a second layer with distributions. But even if you do end up paying taxes on dividends, what you have is 21% tax rate at the corporation and a up to 20% tax rate for capital gains coming through those dividends. Okay. And I've seen this before. I once saw a guy who was at a partner in an accounting firm, which I will leave all of the other details just totally, I'm leaving them out of it for this, right? But I saw him say, well, it's 41%, right? 21 plus 20, 41%. And that's not correct. Okay. So here's how we want to think about it. When we look at corporate taxes are going to be 21%. And then if you pay dividends, we're applying another 20% on top. And so what happens, the math on that actually ends up that you're basically 63 cents on the dollar is the net that you keep if immediately day one you pay two levels of tax, right? You pay 21 and then you pay dividend tax on top on the net that's left. You end up with 63 cents on the dollar. Well, the highest personal tax rate today is 37%. What's 100 minus 37? 63. 63 cents on the dollar is what you keep on the personal side. So if you're at the top tax bracket, it's totally neutral, right? That pass through is totally neutral. And there's some layers in there with brackets and whatnot. Certainly, what's the impact of any potential double tax is absolutely something that we would need to explore and look at to evaluate. Does this make sense for you? Again, sometimes the answer is yes, sometimes the answer is no. The point of this strategy is for money that you don't need or want to consume today to end up as retained earnings in the C corporation. If you're earning 5, 6, 7% inside the C corporation on those retained earnings, every year that you've got the tax savings that's waiting there, you're ahead of the game, even if you do end up having to pay some dividend tax later on distributions. But we'll talk about that in more detail. How does it apply to your situation as we look at the details of your situation in an appointment together. Just understand you're not losing. There's not an extra cost happening because of any kind of double tax there. And then last question that we got here that I'll field today. A couple more came in that I think just time, we don't have time to get to all of them. Last one that came in is, well, I already have a CPA. How does that work? Like, how do you guys function alongside a CPA? And I'm really glad that you asked that because accountants are really important. We work with a lot of accounting firms, and our goal is not to be your CPA. Our goal is to support with overall wealth building structure for your world. And so we can help support some of these pieces like management fee analysis. We can help support the evaluation of how do you put dollars to work as you go through and build. Does this make sense? We find that we do our best work as we get to partner with your accounting team and look at how to build everything for your and your family's benefit as you go. This is not intended in any way to go through and be a replacement of any good relationship you've got with your accounting team. Okay, so great question there. Again, if you're thinking, hey, I don't know, maybe this starts to make sense. Maybe it makes sense that what I'm overpaying optionally to the IRS, I should recapture and put back to work in some way in my life. Be sure to scan that QR code and let's dive in. Let's roll up our sleeves and unpack that stuff together. Okay. I'll end here with just a couple of things, important disclosures for us, who we are. But remember, we've done this with a lot of clients all over the country, managed thousands and thousands of relationships with clients and their businesses. Invite you to scan the QR code. We're really excited to get to meet you and unpack together. Does this make sense? Do we need to explore another strategy? With that, have a wonderful day.